I think we have all felt that brief, that icy moment of panic when you look at your bank statement and you see a transaction you just simply do not recognize.
Oh, absolutely. I mean, that feeling of total vulnerability is universally understood.
Right. And it forces this very immediate, very frantic question of who is actually in control of the underlying machinery that's moving that money.
Exactly. And usually, if it's just a strange $50 charge from a coffee shop halfway across the country, you call your retail bank, they cancel your card, and the money eventually reappears.
Yeah, it's an annoyance. But what happens when that panic isn't over $50?
Right.
What if it's over $50,000 or $500,000 or $5 million sitting in a high net worth private banking account?
That changes the game completely.
It really does. When the stakes are that high, the question of who actually pays for that mistake becomes an absolute battleground. So, welcome to our deep dive.
Thanks for having me.
Our mission today is to decode the incredibly complex world of payment fraud liability. We're figuring out exactly who is left holding the bag when money gets stolen, specifically focusing on the nuances of Luxembourg's private banking sector.
Yeah. And to figure this out, we're looking at the rulebook governing Luxembourg's financial sector, specifically the 2009 Payment Services Act, alongside some upcoming European directives.
To see how courts and regulators actually assign the blame.
Exactly. And what you quickly realize looking at these legal analyses is that liability, well, it's not a simple yes or no question.
Right.
It is a highly intricate dance of digital evidence, rigid technical standards, and honestly, ticking clocks.
Okay, so let's unpack this, because we all fear getting scammed.
Yeah.
But the mechanics behind the scenes, how banks and the legal system actually categorize these nightmare scenarios, it's fascinating.
It really is.
Because it seems like before anyone can even demand their money back, the law has to decide what kind of mistake actually happened, right? The bank doesn't just treat every missing dollar the exact same way.
No, not at all. The legal qualification of the event is the foundation of everything that follows. Under the payment services regulations we're looking at, the law essentially sorts payment errors or fraud into 3 distinct buckets.
Okay, 3 buckets.
Yeah, and the bucket your situation falls into dictates your entire path to getting your money back. The first and most straightforward bucket is the unauthorized transaction.
So, if I'm trying to visualize this, an unauthorized transaction would be like someone physically pickpocketing my wallet, stealing my credit card, and swiping it at a store.
Right.
I had zero involvement. I never gave consent for that to happen.
That captures the essence perfectly. The defining characteristic there is a complete lack of payer consent. Someone else initiated the machinery entirely without your permission.
Got it. Okay, what's the second bucket?
So then you have the second bucket, which the law calls defective execution. This is a scenario where you, the payer, absolutely authorized the payment, but something broke down in the actual delivery of those instructions.
Meaning, I did everything right, but the bank basically tripped over its own shoelaces.
Yeah, pretty much.
Say I authorize $100 to go to my friend John, but a glitch in the bank's processing center routes $1,000 to a totally different person named Jane.
Exactly. The machinery failed to carry out the valid instructions correctly. It could be sending the wrong amount, routing it to the wrong beneficiary, or even just an unreasonable, damaging delay in the transfer.
Okay, so in those cases, the breakdown is clearly on the execution side, the bank side.
Right. But the third bucket, however, introduces the most complex scenario, and it's the one dominating the news right now. The law refers to this as the deceived payer.
Ah, the deceived payer. This has to be the scams where people are tricked into wiring their own money.
Yes.
The situations where I genuinely consent to the transaction, I push the button myself, but I'm doing it because I am being manipulated by a fraudster on the other end of the phone.
The industry terms this authorized push payment fraud, or APP fraud, and from a legal standpoint, it is incredibly thorny.
Why is it so thorny? Just because you agreed to it.
Exactly, because you, the account holder, used your real credentials, you pass the security checks, and you actively push the button, so the bank's automated systems see a completely valid request.
I really want to make sure I'm grasping the legal distinction here, and that you at home are getting this too. So it's the difference between a burglar picking my lock while I'm asleep.
Which would be an unauthorized transaction.
Right, versus a burglar wearing a very convincing delivery driver disguise who knocks on my door and I voluntarily hand over my keys. That makes me a deceived payer.
That is spot on.
The bank treats me pushing the button under false pretenses completely differently than someone just stealing my card.
You've hit on the core issue. Because you technically authorized the payment in that deceived payer scenario, It does not automatically trigger the rapid refund mechanisms that are built into the law for purely unauthorized transactions.
Wow, okay.
Yeah, the categorization entirely shifts how the bank is legally required to respond to your panic.
That feels like a massive technicality that leaves a lot of people stranded. So let's explore that bank response. Let's say my lock was picked. It's a clear-cut, unauthorized transaction. I call the bank in a panic. How fast does the law actually force them to act to make me whole?
The starting point in the law, the baseline requirement for an unauthorized transaction under Article 87, is highly protective of the consumer. The bank must reimburse the client rapidly.
But what does rapidly mean in banking terms? Usually that's like 3 to 5 business days.
Actually, the regulation specifies no later than the end of the following business day.
By the end of the next business day. Wait, really?
Yes.
That is incredibly fast for a massive financial institution to investigate a claim, admit a flaw, and return the funds. I assume there's some kind of emergency brake the bank can pull if they think I'm making it up.
The law does provide an exception, but it is not one the bank can use lightly. If the bank has good reasons to suspect fraud on the part of the client, meaning they think you are lying about the lock being picked, they can pause that rapid refund.
Okay, that makes sense.
But they can't just make that decision internally and sit on your money. They are legally obligated to communicate their suspicions in writing to the financial regulator.
Which, in Luxembourg's case, is the CSSF.
Exactly.
So that prevents the bank from just dragging their feet or ignoring customer complaints just to protect their own bottom line. They have to formally flag it to the government authority, which I imagine opens them up to regulatory scrutiny if they're doing it without good reason.
It creates unnecessary friction, but it also leads directly into how the bank defends itself under Article 86. Because if a bank wants to deny that rapid refund, if they want to claim that the transaction was actually authorized by you or that you were grossly negligent with your security, the burden of proof sits entirely with them.
Entirely on the bank.
Yes. And this brings us to a core concept that every listener should remember today. If you take one thing away from this deep dive, it is this thesis. A fraud file is an evidence file.
A fraud file is an evidence file. I really like how definitive that sounds, but what does it actually mean in practice?
Well,
because in my head, I always assumed if my password was used to log into my account, I was automatically on the hook.
Right.
The bank just prints out a log saying password entered correctly and case closed.
That used to be the common assumption, but the current regulations demand much more. The mere fact that a payment instrument or a password was used does not automatically prove that you authorized it, nor does it prove you were grossly negligent.
Oh, wow.
Yeah, to shift the liability back to you, the bank must build an airtight evidentiary chain.
How deep does this evidence file actually have to go to satisfy the law then? If a simple computer log isn't enough, what are they looking for?
They have to produce a comprehensive technical and environmental record. It's about proving a negative, which is, frankly, incredibly difficult.
Proving a negative how?
They must prove the integrity of the authentication data itself. They must definitively prove the absence of any technical failure or glitch on their end at the exact millisecond the transaction occurred.
That's intense.
They have to document that they tested the notification timelines perfectly. They are essentially forced to prove that the digital environment surrounding your login was completely secure, uncompromised, and operating flawlessly.
That is a massive shift in how I imagine the banking system works. So the bank has to act like a forensic investigator just to prove they didn't mess up.
Precisely.
But if simple passwords aren't enough evidence to protect the bank, there have to be a golden standard. What is the actual mechanism the law requires banks to use to ensure they have this evidence?
That mechanism is known as strong customer authentication, or SCA. And SCA is essentially the fulcrum upon which financial risk is allocated between you and the bank.
Okay, SCA.
The rules for this are laid out in European directives like PSD2, and they require the use of independent authentication factors.
Here's where it gets really interesting. How does SCA actually work? Like, what are these factors?
The law dictates that authentication must rely on factors from at least 2 of 3 distinct recognized categories: knowledge, possession, and adherence.
Okay, let's translate those. Knowledge is something only you know. So, a password, a PIN code, or the answer to a security question.
Yes, the classic first line of defense. The second category, possession, requires something only you physically have.
Like my phone.
Exactly. Your smartphone or registered SIM card, or one of those little hardware token generators the bank gives you that spits out a new code every 30 seconds.
Oh, I have one of those. And the third category, adherence, is something you are. your biology.
Right.
A fingerprint scan, facial recognition on your phone, or a retina scan. It sounds like a spy movie vault.
It does, doesn't it?
To get to the gold, you need the retina scan, which is inherence. You need to slide the physical key card into the slot, which is possession, and you have to punch in the nuclear passcode, which is knowledge.
The vault analogy is highly illustrative. The law requires the bank's digital vault to use at least 2 of those 3 checks. But the most critical word in the regulation is that these factors must be independent.
What does independent mean in this context? If I type my password into my phone, aren't they just happening at the same time?
Independence means that the breach of one factor cannot compromise the reliability of the others.
Okay, give me an example.
For example, if a hacker manages to steal your password, your knowledge factor, that stolen knowledge should not help them bypass your fingerprint scan, which is your inherence factor.
Ah, I see. That makes sense. It's why security experts always complain about getting authentication codes sent via text message.
Exactly.
If a hacker does a SIM swap and steals my phone number, they suddenly control my possession factor. And if they use that phone number to reset my password, they just use my possession factor to compromise my knowledge factor. They aren't independent anymore.
The design of the system is everything. The mechanisms must be properly combined and triggered at the exact right moment during the transaction. And this is where the law, specifically Article 88 2 bis of the 2009 Act, introduces a severe penalty for the bank.
What's the penalty?
If a payment service provider fails to require strong customer authentication, if they leave the spy vault door open and just let a transfer go through with a simple password, the liability completely shifts away from the consumer.
Wow. So if a fraudster drains my account and the bank didn't bother to check 2 of those 3 independent boxes, the bank essentially buys the risk. They have to pay me back out of their own pocket.
Unless they can prove you're the one orchestrating the fraud against your own bank, yes.
Failing to implement SCA is a spectacularly costly compliance failure for an institution. It provides a massive blanket of protection for everyday retail consumers.
Okay, so we have established this very stringent set of consumer protections. We have the rapid refund baseline, we have the requirement that a fraud file must be a deep forensic evidence file, and we have the strict technical standards of the strong customer authentication vault.
Right.
But our sources point out that the high net worth private banking sector operates very differently than an average retail checking account, and that creates a real puzzle. The operational realities are worlds apart. Retail banking is designed for mass volume and high automation. You tap your card for a coffee, the automated system checks the parameters, and it approves or denies the transaction in milliseconds.
Super fast. Yeah.
Private banking, on the other hand, is built on entirely different friction points.
Is it just because the numbers are so much bigger? I mean, moving $5 million obviously requires more scrutiny than buying a latte.
The high value of the transfers is a factor, certainly, but the fundamental difference is the nature of the relationship itself. Private banking relies heavily on manual validation channels and deep involvement from dedicated relationship managers.
Let me put myself in the shoes of a billionaire for a second.
Must be nice.
Yeah, right. Instead of just tapping an app, I might actually pick up the phone while I'm on a golf course, call my guy Charles at the bank and say, "Hey, Charles, it's me. Can you wire $10 million to this new real estate investment vehicle by the end of the hour?"
And that human element, which is the ultimate luxury in customer service, clashes violently with the rigid, automated requirements of strong customer authentication.
Oh, I see where this is going.
Think about your spy vault analogy. How does Charles, the relationship manager, apply a strict digital possession and inherence check over a cell phone call?
He really can't. He just recognizes my voice and knows we talked about this deal last week. So the evidentiary chain we talked about earlier suddenly has a massive human-sized hole in it.
The complexities in maintaining a clear technical audit trail when manual steps are involved are enormous. System failures in private banking often happen when trying to apply exemptions to SCA or in the initial system design that tries to accommodate these bespoke client requests.
That sounds like a total nightmare for a private bank's compliance team. Does the law recognize that difference? Do private banks have any wiggle room to serve these clients without taking on infinite liability?
The legislation does provide an allowance, specifically under Article 78, but it raises a very important question about who is actually protected by these consumer laws. The regulations contain specific allowances for contractual derogations, but only for what they call non-consumer clients.
Non-consumer clients?
Yeah.
So, everyday people are consumers. Who counts as a non-consumer client in the private banking world?
We are talking about institutional entities, family holding companies, patrimonial vehicles, complex corporate investment structures.
Okay, so the big players.
Exactly. Because the law views these entities as financially and legally sophisticated, they are allowed to agree, via contract with the bank, to bypass some of those strict consumer protections.
Wait, let me make sure I'm following the logic here. Imagine I manage a family office, and I'm trying to close a $50 million real estate deal in Dubai.
Okay.
But my bank's automated system keeps blocking the wire transfer because I'm out on a yacht and I can't receive their SMS authentication code. I would be furious.
You'd probably threaten to move your assets.
Exactly. So to avoid that friction in the future, the law allows me to sign a waiver with the bank saying, don't worry about the strict SCA rules, just execute my trades when I call you.
That is the exact trade-off. Convenience for liability. The legal sources we are looking at stress the absolute necessity of a clause-by-clause review for these non-consumer clients.
Because they're basically stripping away their own safety nets.
Precisely. Because if a patrimonial vehicle signs an agreement opting out of certain SCA requirements for the sake of frictionless transfers, and a fraudster exploits that manual phone call channel, the baseline protections like the rapid refund may not apply to them at all.
Meaning the family office might accidentally sign away their legal safety net, and if they get scammed, the liability remains entirely with them.
It's huge risk.
So if you were listening to this and you manage an investment structure or a family office, you really need to go read the fine print on your banking agreements today. You need to know exactly what protections you may have opted out of in the name of VIP service.
A very sound recommendation, because the landscape of fraud is constantly evolving. As we see how manual channels create vulnerabilities in private banking, we also have to look at how fraudsters are adapting their tactics to exploit those exact human vulnerabilities.
Right. Fraudsters aren't just sending poorly spelled emails from fake princes anymore. The technology is adapting. And one of the most terrifying ways they're doing this is by impersonating the banks themselves. How is the legal framework racing to catch up to this?
To understand the regulatory horizon, we have to look at upcoming European regulations, specifically the proposed Payment Services Regulation, known as the PSR, and the proposed Third Payment Services Directive, known as PSD3.
Right.
While not fully applicable yet, the provisional agreements point to a very targeted tightening of the rules across the financial sector.
What kind of tightening? Because how do you legislate against someone lying on the phone?
The upcoming rules focus heavily on systemic verification and information sharing. We're looking at mandatory checks that match the name of the payee to the unique identifier, like the IBAN, before a transfer clears.
Well, that makes sense.
Yeah, there will be stricter blocking measures for suspicious transactions and mandatory sharing of fraud-related information between different banking institutions so they can spot patterns faster.
So what does this mean for you, the listener? Let's go back to that deceived payer scenario we talked about at the very beginning. I think this is a massive, real-world anxiety for anyone with a bank account.
The bank impersonation scam.
Yeah. You get a phone call, and your caller ID literally says Luxembourg Private Bank. The person on the other end sounds incredibly professional. They have some of your actual account details, maybe your address or the last 4 digits of your card.
They're very convincing.
Extremely. And they tell you your account has been compromised, and you need to move your funds to a safe account immediately to protect your money.
That is the textbook definition of authorized push payment fraud. Under current interpretations, because you, the client, authenticate the transfer to that safe account, you often bear the loss.
Which is brutal.
It is. The bank system sees a valid authentication. Unless you can prove the bank failed in its SCA duties, you are stuck holding the bag.
Which feels incredibly unfair when the scammer is using technology to perfectly spoof the bank's own phone numbers. How do these new PSR and PSD3 rules change that dynamic?
The proposed PSR attempts to create a much more protective reimbursement layer specifically for victims of this type of spoofing.
Okay.
Subject to the final adopted text, if a fraudster successfully impersonates the payment service provider to deceive the client, the liability might shift back toward the institution. This is especially true if the bank failed to utilize the new, stricter prevention mechanisms like the pay name matching.
That is incredibly encouraging. It feels like the law is finally recognizing that when a scammer can perfectly fake a bank's digital footprint, You can't just blame the consumer for believing it.
Exactly.
The banks have the massive technological power and resources, so they need to shoulder the burden of verifying identity on both ends of the transaction.
The regulatory philosophy is definitely shifting. It is moving away from merely securing the login moment and towards securing the entire context and communication channel of the transaction.
Well, we've covered a massive amount of ground today, diving into the deep end of financial law. Let's briefly recap the journey for everyone listening to make sure we have all the pieces. We started by navigating the 3 legal categories of payment errors.
Right. The unauthorized transaction where you have no involvement, defective execution where the bank messes up, and the deceived payer where you are tricked into pushing the button.
Building on that categorization, we unpack the crucial concept that a fraud file must actually be a robust, comprehensive evidence file. It is not just a technical log of a password. It is an affirmative proof of the system's complete integrity.
And we broke down the SPY Vault strong customer authentication, the requirement for independent factors of knowledge, possession, and inherence, and how failing to secure that vault shifts the liability squarely onto the bank.
We also looked at the unique friction points in private banking, where high-net-worth clients might actually contract away those very protections for the sake of convenience.
The ultimate takeaway for anyone navigating this space is that the exact context of how a payment was authorized dictates your entire legal standing. System design, strict compliance, and the depth of the evidentiary chain are the true battlegrounds of payment fraud today.
Absolutely. The days of a bank simply looking at a screen saying, your password was used, case closed, and hanging up the phone are legally over. But as we wrap up this deep dive, I want to leave you with a final, forward-looking thought.
Okay, let's hear it.
Something to mull over on your own that builds on everything we just discussed about how we prove who we are. We talked about the 3 categories of strong customer authentication: knowledge, possession, and inherence.
Right.
Inherence is supposed to be the ultimate security. It is your unchangeable biology, your fingerprint, your retina, your voice. But as AI voice cloning and deepfakes become virtually flawless and incredibly cheap to produce, how will that inherence category actually hold up?
Wow. It introduces a terrifying new vulnerability to the evidentiary chain.
Think about it. If a scammer can scrape 10 seconds of audio from your social media, perfectly fake your biometric voice print, and use it on a phone call to bypass the very thing that makes you unique, will our own biology become the weakest link in the banking system?
That is a chilling thought.
It really makes you wonder what the spy vault of the future will even look like when you can't even trust the sound of your own voice.
Thank you so much for joining us on this deep dive. Stay curious, check those banking agreements, and we will catch you next time.